All right, we're going to get stuck into it, guys. Welcome everyone to SF Capital's first webinar. It's called Managing Your Home Loans in Uncertain Times. For everyone who's on the line who doesn't know me, my name is Tommy Lim, and I run a mortgage broking firm called SF Capital. I wanted to say a special thank you for making the time to join us today, and a thank you for inviting me into your homes, your home offices, or wherever you might be today. I wanted to create this webinar in direct response to what's happening to COVID-19, and especially in the economy. This is a presentation for anyone who is experiencing some form of financial hardship, but also just a presentation that I wanted to deliver to give some practical tips on how to manage and optimize your home loans during this time. Okay, so let's get stuck into it. Before we did, I just wanted to do a quick video and quick sound check. Please say hello or call out your name on the chat if the audio and the visual is okay for everyone in the audience. Yeah, just yeah, give us a shout, and Fiona, who's with me in the office today, will give me the signal that everyone can hear me and see me okay. All right, we're going to get stuck into it now. Well, let me hide the control panel. Oh, always happens. There's always a delay on PowerPoint. All right. So as we get started, just wanted to provide a general disclaimer to everyone that this is just advice that's very general in nature. It doesn't take into account anyone's specific personal scenarios or personal numbers. So if you're looking to act on any of the content that you hear or see today, please consult with us first, or any other sort of advisor that's relevant to make your decisions, whether it be your financial planner, your accountant, or any sort of legal advice. If it's about lending, please speak to us first before you act on anything that you hear today. All right, just by way of introductions, for those of you with us that don't know who SF Capital are, we're a mortgage broking firm based in Sydney, and we specialize in both residential and commercial lending. So this is all types of home lending, whether it be home loans or investments, as well as all types of commercial lending, whether it be asset finance, who's run by Luke on the team, or commercial property, or any sort of lending with a business need. Today, however, the topic is about managing your home loans in uncertain times. So we'll focus primarily today on residential lending. And what we're known for resi lending, as well as commercial, is getting really tough deals approved for our clients. But on top of getting those tougher deals approved, we're also well known for great client service. SF stands for Service First, and over the years, we've been fortunate enough to be recognized with a number of awards for our service and what we do in the market. And this year, we were fortunate enough to be recognized as a finalist for the MFAA's Customer Service Award. We're very qualified to talk about residential lending. Across a bunch of lenders, we're recognized as elite brokers or premium brokers. And then we're very well reviewed on Google as well as Facebook reviews. So if you want a testimonial about what we do, please jump online and feel free to read our reviews. A bit about me, for those of you who don't know me. Again, my name is Tommy Lim. I run SF Capital. And just a bit about me, I'm married. No kids as yet, no announcements, but happily married. I studied law at UNSW and worked as a management consultant after that, before starting SF Capital. Really passionate about investing, whether it be share investing or property investing, and I was fortunate enough to buy my first property in Chippendale at the age of 24. So tried to get into the market early and really practice everything that I've read and studied about investing. Now, the topic today is managing your home loans in uncertain times, and the uncertainty is caused by COVID-19 the coronavirus, I have a personal vendetta against the coronavirus because COVID-19 took away two dreams of mine this year. I was meant to go to the Tokyo Olympics, had spent a lot of money booking those tickets and was really looking forward to it with my wife. But of course, that got pushed back to 2021. And also, I was actually meant to attend the Booth School of Business this year under the executive program. But unfortunately, that got pushed back till August, and then it got put online. So still evaluating that decision whether to start this year. But all those things were very disruptive and caused by COVID-19. All right, let's get stuck into the content of today. COVID-19 has been a very difficult time for many. It's been an economic crisis just as much as it has been a health crisis. What we're going through now has been uniquely described as a 1 in 100 year event, a once in a lifetime event, a challenging time, an unprecedented time, and all the economic data that is now emerging really reflects that. So you would have been reading in the headlines, economic growth for this quarter, the June quarter, is going to decline by 10%. There's forecast for the unemployment rate to be at 10% as well. We've seen falls in the share market and the property market. We'll wait and see. The latest headline I read this week was that every week that the social distancing measures are in place, the Australian economy actually forgoes 4 billion a week in terms of GDP output. So these are massive numbers. Now, from this uncertainty and the disruption, the government, the RBA, and of course, Team Australia, everyone involved and everyone in the community has been talking about building a bridge to the other side. So from this disruption, how are we going to get through this, and what are we going to do, and what initiatives can we put in place? This bridge building activity is something that I feel passionate about, and hence why we created this presentation today. So this was the Harbour Bridge when it was first being built. Hopefully, once we get through all this, we'll get to the other side. And to do that, we're going to be talking about 5 topics that are important to managing a loan in this time. The first is, so this is today's agenda. The first topic will be deferring your loan. The next will be negotiating your interest rate. Thirdly, will be fixing your rate or fixing your loan. Finally, we'll talk about refinancing to manage cash flow. And then number 5, we'll consider the policy changes which might impact your ability to borrow today. Now, it's important to understand the context. Slide change. Okay. So to understand what you can do, we need to understand the role of the banks in this economic environment. So there's been comparisons and contrasts between COVID-19 today and the GFC. They are actually very different events, and the role of the banks has been very different in both times. So during the GFC, banks were actually amplifiers of the economic distress that were happening. They were actually the causes of subprime mortgages being issued, and the rabbit hole went really deep in terms of the damage that banks' decision-making had caused. But today, because banks are well capitalized and they're actually cooperating with the government in terms of how they manage COVID-19 with their borrowers, banks have been described as acting as shock absorbers in what's happening today. And there's been a bunch of different initiatives, but the main initiative in relation to home lending is our topic number 1, the ability to defer your home loan if you wish to. So this is the first thing we'll talk about. Deferring your home loan is like hitting the pause button on your home loan. So this means a complete stop to repayments. Now, depending on the bank, many banks are deferring the repayments completely for 6 months. So for example, CBA, if you're a client, you ask for online deferral, it'll be paused automatically for 6 months. Others are 3-month request with a review and then 3 months afterwards. We haven't hit 3 months yet, but it's very likely the review will and the following 3 months will also be automatic. Now, the thing to note is most majors have made it quite simple. It's just an online form and automatic deferral. But if you're with a smaller lender or a non-bank, it can be a very manual process, such as through email or such as through an application form to get the loan deferral. So depending on which bank you're with, have a discussion with us if you're going to make this decision, and I'll talk about the key considerations soon. Now, the thing to note is when you defer your loan, you get the benefit of a pause in the repayments, but a loan deferral isn't for free. You're actually charged during the period. It's very important to know this. So before you defer your loan, let's take, for example, a $500,000 loan at 3% over 25 years. If you do the P&I calculation, that comes to $2,371 per month. Now, what happens when you pause the loan is that interest will still be charged, but on an interest-only basis over this period. So the repayments or the interest calculation on 500,000 at 3% is 1,250 per month. If you have a 6-month deferral, this becomes 7,500 a month. And what happens, guys, is this actually gets added to your loan to become a new balance of 507,500. And this is what the loan is reset to, and what repayments are reset to after the loan deferral. So essentially, the 507,500 over 25 years at 3%, the repayment becomes 2,407. So that's actually not much, guys. That's 36 bucks a week. And this process of adding the interest is called capitalizing the interest. But it's important to know that over the life of your loan, 36 bucks a week and 36 bucks a week from borrowing an extra 7,500 over the remaining 25 years becomes 10,670. So I'm not saying that this is necessarily a bad thing. It's just important to be aware of the costs. And because that 7,500 is amortized, so repaid over the remaining years, interest is actually charged on interest. So on the 7,500, the interest component on the 7,500 is 3,170. So these are the numbers to keep in mind if you're evaluating the costs of deferring your loan. Okay, so that's what it is. Before you make that decision, these are the key considerations. Deferring your loan is probably the most significant step you can do. It's really meant for clients on financial hardship. So this is for clients who have lost their job or experience a substantial or significant decline in income. If you're still employed, gainfully employed and fully employed, it might not be the best decision to actually defer your loan. However, you can still use it as a precautionary measure if you are uncertain. Next, it's not intended to impact your credit file. And then finally, we're going to be talking about a whole range of other options first before you make a decision to defer your loan. So you can access advanced repayment. So if you've been paying extra into your loan, you can access redraw or switch to the minimum contracted repayments. And then what we'll be going through in the next 3 topics is negotiating the rate, fixing the rate, or restructuring and refinancing your loan altogether. Okay, I'm going to switch to topic number 2, which is negotiating rate. Before I do that, I can see there'll be some questions coming in. I do welcome questions and encourage you to send through your questions. What I'll do, guys, is I'll actually answer them and take more questions at the end of the presentation. So please send them through, and then we'll be going through them at the end. If we don't get to all of them, what I'll do is me and the team will divide up. The team and I will divide up the questions, and we'll get back to you in an email. All right, so negotiating your rate. Okay, so negotiating a rate is a quick win. This is how to reduce the cost of your home loan effective immediately once the rate negotiation is successful. It's basically the path of least resistance, which is going to give you an immediate reduction. Now, each bank has its own process. So just like the loan deferral, it can be online, it can be manual, and it's often part of a retention process to keep you as a client. So each bank has its own process, and as a broking firm that deals with a lot of lenders, we know the unique process of each lender. It's also important that your loan is variable. If it's fixed, you actually can't negotiate the rate. You have to wait until the fixed rate is expired. And then on top of that, if you've recently negotiated the rate in the last 6 months, the bank is unlikely to give you a further discount. You're going to have to wait until that 6 months elapses. Okay, so in terms of the degree of discount that a bank can give, this is constantly changing, and it's actually different for every client. The level of discount is driven by a bunch of things. Importantly, the amount of lending, also the amount of net lending. So if you've got a bunch of money in offset, it's very unlikely the bank's going to give you a big discount. The type of loan, whether it's be interest only, principal and interest, owner occupied or investment, and the loan to value ratio. So this is the value of the loan relative to the value of the property. Now, other factors that you might not fully see in the bank's decisions, the cost of funding and the economic environment the bank is currently in is really important to giving you a good rate. And finally, the competition from the banks is important. So if one bank comes out with a special, then it's likely another bank will match it. That competition is what helps drive pricing further. Okay, as a broking firm, like I said, we deal with a lot of lenders. We actually have the tools to do it for you, especially with the major banks. So this saves you as the client a lot of time calling yourself, and it also avoids you having to know what to say or do. We actually have the tools to do it for you. And for all the SF Capital clients on the call, we do an annual review of our clients' loans each year on an opt-in basis. So basically, you have to participate in the annual review for us to undertake a rate negotiation for you. So this is a sample, guys, of rate negotiation outcomes across a bunch of lenders and across a bunch of different types of loans. It's a table of different results, which I'll pull out the key insights. So firstly, guys, banks are lazy. It doesn't matter which bank you're with or what type of loan you're on. Banks are lazy to pass on rate discounts to what they call the back book. So old clients, ironically and unfortunately, actually get worse rates than new clients. So it doesn't matter which lender you're with, what type of loan, it's worthwhile asking, and there often are savings available. Next is, these are the amounts of savings. So you can see a rate negotiation doesn't save you necessarily hundreds or thousands off your loan, but it is something back in your pocket to help you save money. And this is important if you're budgeting in an uncertain environment or you've had a reduction in income. Finally, the bigger the loan, the more savings are available to you. So for clients with larger portfolios, it's definitely worth revisiting your rates, and basically the savings are larger the more lending that you have. In terms of negotiating rates, here are some key considerations. Okay, the first thing is to be realistic and compare apples with apples. So we know, oops, I put my phone on silent. Okay, so we do this every day, guys. We help negotiate clients with new lending as well as optimizing the existing lending. It's important to be realistic and compare apples with apples. So I can't count the number of times that a client who is with CBA will actually quote a rate from loans.com.au or Athena. That's not comparable, and it's not realistic in terms of driving an appropriate rate outcome. You need to basically understand that a comparable rate is with a comparable lender. So if you're with a major, the right lenders to be comparing with, say you're with NAB, would be ANZ, St. George, Westpac. Or if you're with ING, perhaps Macquarie, or a more challenger bank like Suncorp, ING. Those are comparing apples with apples. So that's tip number one and consideration number one. The next is to be patient. This is because it's a process, and we actually have a queue to get through these when we go through them. And in turn, the bank has a queue as well. In addition to that, there is some basic collection of information, like what your rate is on now, what the loan balance is, understanding the value of the property. So be patient. This is not even though there is an online tool, it's not an instantaneous result. You actually have to go through a process. Unfortunately, as I said, clients get a better rate. We'll send this information out afterwards, but if you follow that AFR link down the bottom, there's actually studies and inquiries into why new clients get better rates than old clients. But essentially, new clients get a better rate. So if you're in the ballpark of what a new client gets, that's actually a really good outcome. Banks use price to attract new business, and unfortunately, the new clients usually get a better rate. Fourthly, participate in our annual review. This is money for the taking, guys. We, at this point in time, do not charge for this service, and there's so many clients that actually don't participate in it and leave money on the table. If you see an email from us, it's going to be important, and especially about the annual review, please opt in when you see that communication. Finally, if after the rate negotiation, you're still not happy with the outcome, whether it be the price itself or the cash flow impact, you may need to refinance and restructure your loan. So that's what we'll be talking about in a couple of agenda topics. All right, moving on. Number 3, this is a more topical question, which is this the right time to be fixing your loan? So I'm actually going to run a quick poll on that question. But before I do, I just want to describe for those people who aren't aware what a fixed rate is. You can choose between a variable rate, which changes as the bank requires, and usually it moves in line with the RBA in terms of changing the cash rate. What a fixed rate does is it locks in your rate for an agreed period of time, of which you receive the benefit of a certain repayment every month for that period, but the bank gets the benefit of having you as a client for that amount of time as well. And if you leave early, there can be break costs associated. All right, so I'm going to launch this poll as a bit of fun, which is from your knowledge of the marketplace. Do you think this is a good time to fix your rates? Yes, no, not sure. Yeah, we'll just see what people think. All right, I'll give another 5 seconds. All right, so the answers are in. It was pretty overwhelming that if you can see that responses, 80% of our audience think it's a good idea to fix your rate at this point in time. So I'll kind of elaborate on that in the next few slides. Okay, so have I stopped sharing it here? Okay, awesome. All right, so just the context to fixing your rate and where rates are at the moment. In March was an unprecedented or very rare month for the RBA. There were 2 rate cuts in a single month, and this was in direct response to the economic events unfolding from coronavirus. So in the RBA's normal meeting on the first Tuesday of the month, they dropped the rate to 0.5. That was a historic low. And then on the 19th of March, Philip Lowe, governor of the RBA, announced an out-of-cycle rate reduction to a historic low of 0.25 on the 19th of March. And this is where the cash rate sits today. And it's Philip Lowe has made it very clear that this is the effective lower bound for the Australian economy in terms of interest rates. So and this is in line with other economies, New Zealand, UK, US. They do not want to follow European countries and Asia, especially Japan, in putting rates negative. 0.25 is the effective lower bound, and any further facilitation of credit in the economy will be done through a process called quantitative easing, which is basically the RBA stepping into the marketplace to act as a market participant to support the flow of credit. Now, from this second rate cut, so the 0.5, we saw all the banks pass it on in terms of variable rates, but the second rate cut on the 19th of March, only ANZ passed on that rate cut to their variable rates. The other banks did not move, and rate cuts were only passed on in fixed rates. That's just an important thing to note as we go through this. You can see that this is how rates have been tracking over the last few decades. There's been a downward trend. Now, even though rates are at a historical low, it's very clear that the banks are going to find this period that we're in, and for the next few years, they're going to find it very difficult for their earnings. So they're going to have a lot of bad debts incurred. Their compliance and operating costs managing this and other things going on are going to increase. And basically, and there won't be in a down economy, there's very little new lending happening. So basically, their margins are going to be compressed. And there's only one way to increase your margins: either cut costs, which is not going to happen because costs are increasing, or increase your revenue, which the bank's lever is increasing their interest rates. So because of this, because of the challenges that banks are facing, our house view is that now is a good time to fix. You have to consider a bunch of different things before you make that decision. But for owner-occupied P&I and for investment, it is fixed rates are looking very attractive. And I'll go through this table of before and after that second rate cut from the RBA. So the biggest fall in fixed rates was seen in owner-occupied P&I lending. This was promoted as a special or as a direct response to help clients during COVID-19. Now, of course, banks get to keep you for another 2 years when you fix the rate. But you can see in this table the largest cuts to rates happened in owner-occupied P&I lending. There was no movement in owner-occupied interest-only lending. There were no changes announced at all. And you can see these rates are actually designed to deter clients from choosing this as their loan structure. In the middle, investment rates did receive rate cuts to them. And these are unprecedentedly low investment rates across P&I and interest-only, which really signals that the bank is no longer concerned by stimulating investment lending, or they're no longer concerned about having a lot of interest-only lending for investment loans. In fact, the pricing suggests that these are now at levels which they actually want more of that business. So just to summarize, the green P&I owner-occupied and the yellow investment loans are where the attractive fixed rates are, not in owner-occupied interest-only. All right, so even though our house view is it's a good time, you need to consider your personal circumstances. So these are the considerations. If you need to make a change to the loan within that 2-year period, do not fix the rate, because you're going to incur break costs restructuring your loan. So, for example, you're going to sell the property, or you need to do a variation on the loan. That you will incur break costs fixing it. That break cost can be a 4-figure sum plus more, depending on your loan size. Fixed rates don't often have offset accounts. So if you have a large sum in offset, it might not be suitable to fix the rate. Therefore, if you may instead want to consider just fixing a portion of the loan and leaving enough variable so you get the benefit of offset from your current savings, as well as the savings you may accumulate during that fixed rate period. And then there are, even though offset is not common, there are products in the market that have a fixed rate with an offset account. which you might want to consider. Teachers Mutual Bank and their subsidiaries Unibank being one of them, is a unique product in the market which has a fixed rate and an offset account. And then finally, banks use fixed rates to attract clients and attract new customers. So it's important to know that you get that benefit now, but you should watch for the reversionary rates afterwards. So this is where our annual review comes in, and making sure that when the fixed rate comes off, you will still get the best variable rate that the bank can offer, or you might even want to refix after that period. So watch the reversionary rates. Okay, moving on. How are we going for time? Half an hour, it's good. Okay, topic number 4, guys, refinancing to managing your cash flow. Okay, so we're now moving, so all the deferring your loan, negotiating the rate, fixing your rate, those are things you can achieve even with your bank today. You actually do not need to switch to achieve those things. Refinancing actually means changing banks, or more simply, it means using one loan to pay out another. That can even be done with the same bank, but often it is to switch lenders. And it's important whenever we assess if this is suitable for a client, when we refinance a client, it's important that the client actually receives a meaningful benefit, whether that be a personal benefit or an economic benefit. But we'd always try and achieve some sort of benefit for the client. Okay, so common reasons for refinancing. The most common, and people think about this, is just to achieve a better rate. There's actually, this is just the tip of the iceberg. There's actually a whole bunch of other reasons why refinancing is needed or might be suitable. So we're going to spend a bit more time on restructuring to lower cash flow, how that works. But also, it might just be necessary to refinance because your fixed rate or interest-only rate is expiring. Commonly, we also refinance to help clients achieve a purpose, whether that be using the equity in the property to buy another property, invest in shares, conduct home renovations. Some clients just get upset with their current lender, or the structure that their loans are on are no longer suitable. This is another reason for refinancing. And finally, we often have to refinance a loan due to a life event. Maybe it'd be bad, like a death or separation, or it might be a good thing. For example, a parent passing on a property to a child. Life events can cause the need to refinance as well. Okay. All right, so let's actually look at just achieving a better rate. This is very similar, guys. So we'll focus now on achieving a better rate and restructuring to lower your cash flow. To understand these things, it's important to appreciate the difference between cost and cash flow. So the cost of the loan is simply the interest rate. It is just the price of holding the debt. And this is based on the bank's funding costs and also who you are to the bank. The risk that you present to the bank determines their rate, and there's a risk-reward calculation that they do associated with that. Cash flow, however, is the actual amount of money leaving your bank account every month. And this is determined by how your loan is set up, specifically whether it's principal and interest or interest only, and the number of years left on the loan. Now, in times of uncertainty, and this is the message of all of the refinancing question, is in times of uncertainty, you might be looking to lower your cash flow rather than getting the lowest cost. So for example, if you've got a big investment property portfolio and you know that it's important to hold that through the cycle, because if you sold now, you would be actually selling in a down market. You want to simply lower the cash flow of holding that portfolio rather than trying to get the lowest interest rate. Sometimes both can't be achieved together, and it's more important to lower the cash flow. Let's look at both. So in terms of cost, this is similar to refinancing. This is an example of a 0.25 difference and what it means. So if you look at that $500,000 loan and the rate before was 3.25 and you reduced it to 3%, basically that would mean $66 saving every month. Extrapolating these repayments, so the 2437 at 325 or the 2371 for 25 years, you simply multiply that number by 25 years and you get 230,000 versus 211,000. The saving to you over the 25 years is 19,657. So this is what it looks like for a 0.25 rate reduction. Now, 0.25 is $66. Some clients, really frankly, that doesn't move the needle for them enough to want to switch. So it's really a personal decision whether that's enough for you as a client. And especially $66 might not be enough to move you if you're with a bank that you do everything with and your life is already perfectly organized around that lender with direct debits for your utilities, electricity, credit cards, all that sort of stuff is optimized. Some clients just don't want to move for $66. So it's important to evaluate for yourself if that's enough for you. Now, the next part of that decision is, I talked about a material benefit. You actually need to do a cost-benefit analysis of whether it's right to refinance just for a rate. So there are costs to leave your current lender, and then so that's to discharge the mortgage and to discharge the loan from your current lender is $301.44. Then those costs are mirrored when you enter a new bank. So it actually costs you close to $900 to refinance, and if you're saving $66 a month, the payback period, that's before you start getting a positive benefit from the refinance, is 13.5 years. Sorry, not 13.5 years, 13.5 months. So just 1 year and 2 months. That's another consideration, whether that's too long for you to wait to get the benefit of the refinance. Now, major banks recognize this, and having big balance sheets, they can offer sweeteners. So some lenders are offering rebates to bring you across, and this is basically the realm of the majors. 2,000 is a very common rebate. Some have offered 4,000, which means you're positive from day one. If the cost 887 to switch and they give you 2,000, you're actually up $1,113 from day one when you refinance. So this is the cost benefit equation in deciding to refinance. Okay, moving on to cash flow. So two initiatives you can use to lower the cash flow impact of your loans are switching from principal and interest to interest only. So this means you're just paying the interest. Going from principal and interest means every month an element of interest and principal gets paid down on your loan, whereas interest only is just holding the loan and paying a cost to keep the loan. It doesn't reduce the loan with each repayment. So, for example, as you saw from the other table, interest-only rates attract a higher rate. Banks actually want you to pay out the loan because it's more responsible. Say you had that $500,000 loan at 3%, and you needed to switch to interest-only, and the rate went up 0.75. Your cost is increasing by 0.75 every month, but you can see going from interest only, that repayment goes from 2371 to 1563, meaning a cash flow difference of 809 every month. This might be enough. Say you have a tenant that has reduced their rents, or you have gone through a 20% reduction in your income. This might be enough to make you feel more comfortable to hold the loan and hold the properties through this period. Another initiative that you can do is re-extend the loan term back out to 30 years. And so if you had that $500,000 loan and 5 years had elapsed, it was 25 years, what going back out to 30 would do would go from 2371 to 2108. That difference a month is 263. Whereas if that $500,000 had been reached at 20 years, then I actually think there's a typo here, but I'll fix that up later. Basically, the savings from going from 20 years to 30 years on a cash flow calculation would be 665 every month. So what that means, guys, is if $66 isn't enough to move the needle, then actually you may need to restructure the loan completely by going back to interest only, or re-extending the loan term to achieve more cash flow savings. Actually, I think it's right at 2773. I'll do a check and update if necessary before I circulate the presentation, guys. Okay, so this is what it looks like to manage cash flow. Now, I'm going to give an example of a client that we've done this for. There's more numbers on this page, so be prepared, but I'll step you guys through it bit by bit. Okay, so this is an example if you have a portfolio of loans or a portfolio of investment properties. And this is an example of putting all those things together in terms of negotiating rates, re-extending the terms, going from P&I to interest only. Okay, so we have a client here with 4 properties, a number of loans. It looks very messy, and they have different rates according to whether it's IO, P&I, fixed, variable. Basically, the IO periods and fixed periods have expired on some of these loans. So a few things to note here. The loans are quite messy, and there's a lot of cross-collateralization that has happened to this client's portfolio over time. You can see here, because an LVR should not be 133% of the loan of the property value. This only happens if you're cross-collateralizing. And then secondly, like I said, some IO periods have come off and fixed rates have expired on this portfolio. Okay, so when we see a portfolio like this, we try and bring it back to basics and help the client bit by bit. And this is what we did for this client. So before I go there, you can see the repayments about 11,000 every month for this client. Now, after, this is what we did. Firstly is clean up the portfolio, restructure the loan so that they're not cross-collateralized, but set up on a standalone basis, where possible, 1 loan for each property. Then we negotiated the rates, and we negotiated the rates as well as refixed them, because the client wanted that certainty of repayment, as well as re-extended the repayments out to 30 years. And then finally, you can see from a cash flow impact, these were the savings achieved. And overall, when you add these numbers up, that portfolio went from 11,000 a month to 9,000 a month. So we were able to save this client from refinancing $2,000 a month on their cash flow. So in uncertain times, cash is king. This is going to help you get through a period of reduced earnings and basically help you build your own bridge to get to the other side. Okay, we're going to go to number 5, and this is the last topic. I'll go through this and then I'll go through the questions, which is the policy updates that the banks have been making to make their lending decisions. So basically, refinancing requires you to switch. And when you're switching, you're basically a new client to that bank, and they're going to look at you and your scenario to make sure that you're an eligible borrower for them. And so what's happened during this period, banks have adopted enhanced due diligence measures. And what they really want to know is, have you been impacted financially by COVID-19? So are you still employed by your employer? Are you aware of any changes to your income that have happened or are going to happen? How are your investment properties performing? And then are there any other foreseeable changes to your scenario? Now, this is particularly so if you are in some sort of very directly impacted industry from COVID. So even though all industries to some extent have been affected. There are some ones that have been very directly hit, and these industries banks have identified to really scrutinize the paperwork before they issue a new loan. So tourism, airlines, transportation, not public transport, but yeah, any sort of transportation role, hospitality, retail, sports, art and recreation. These industries have been directly impacted, and banks are doing extra checks. So what do those extra checks look like? Okay, so for PAYG clients, so clients on salaries or wages, variable income is being discounted further. So if you receive bonuses, commissions, or overtime, any sort of discretionary or variable income, the typical discount would be 20%. Some lenders are taking another 20% off that before they use that for your income for servicing. Then, to make sure you're still employed and the income is what you're saying it is, there is a request for your latest bank statement to see the latest salary credit drop in. And some lenders are going old school. They're even calling the employer to make sure you're still in the job. I haven't seen this for a long time, but this is a very old school check that some banks are reintroducing. Okay, if you're self-employed, the checks are similar. There's a request for the most recent BAS to see how you've been tracking this financial year, as well as looking at your trading accounts and bank statements, again, to see if there's continuity of income during COVID-19. Some lenders are even requesting or giving the option to provide a forecast, as long as this is supported by an accountant via an accountant's letter. And then more generally, for rental income, there's checks to see if that's been impacted. The latest rental statement, again, a bank statement to see the credit go in. LVRs are changing. So 70% is becoming the new 80% in terms of decision making. So banks are still lending at 80, but 70% is being identified as the LVR, where you have a smoother process, more generous policy, and better pricing. And again, for some lenders, again, 60% LVR is the new 70% LVR. And then finally, banks are being more restrictive on cash outs in terms of amounts and who gets them. For example, self-employed cash outs are quite restrictive at this point in time. That's because they want to prevent issuing more credit to a client that might be experiencing financial hardship during this time. So those are the trends that we're seeing, and that's a wrap up, guys, for the 5 topics that we've discussed today to help you through this period. So number 1, deferring your loan. Number 2, negotiating your rate. Number 3, fixing your rate. Number 4, refinancing your loan to manage your cash flow. And number 5, the need to consider recent policy changes to see if you're eligible to borrow. All right, so we'll move on to Q&A in a sec. But if you found this useful, or you want more information, or you want to discuss your own personal situation a bit more, I've set up a calendar for anyone to book a time in with me if you'd like to chat. We'll email this out or share the link in the chat. And of course, teamwork makes the dream work. So if you have a direct contact as well in SF Capital who has worked with you in the past, feel free to reach out to any member of the team, whether it be Luke, Priscilla, or Fiona, to book an appointment with them as well to go through your loan. And of course, if you'd like to stay up to date with these updates and news of this nature, please follow us on social media, LinkedIn, Facebook, Instagram. LinkedIn is where I put more my content on about what's going on in the market. So that's probably our primary channel, and then Facebook and Instagram as well for more fun and engagement. All right, so we're going to go to questions now. I'm going to open this up, and we're going to see if we can answer a few questions in the 10 minutes that's left. Okay, Oh man, this box is tiny. All right. Let's pop it out. Okay. Okay, all good. Brad, thanks for your question, Brad. If you're on the line, would a loan deferral count against you if you went for a loan in, say, 18 months' time? So from the news that we've been hearing, guys, a loan deferral isn't meant to hit your credit file. Or it's not meant to impact your credit file in a negative way. So that's the feedback that we've been receiving. I think it's more important that once the deferral comes off, you're able to pay, because missed repayments after the deferral is what's actually going to impact your credit file. But during the deferral itself, it's not meant to impact your credit file. Martin Lawrence had a similar question. I think I still think banks will use the information somehow in terms of deferring, but the decision to defer itself is not meant to impact your ability. Okay, can we watch this video after? Yes, we'll be sharing this on our social channels. Okay, so from Francois Covilla, question was, our fixed rate on our home loan doesn't expire till late September 2020 due to COVID. Our income has slightly changed. So we've been a few days late on a couple of last repayments. Will that affect our credit history? So if it was poor, if you have those difficulty in repayments due to COVID-19, a bank may be able to reimburse you for those repayments that went through. It really depends on your own situation. I suggest, Francois, that we actually book in a chat. You can do that on that Calendly link, or you can send me an email and we'll go through that. Okay, from Dennis Yang, where do you see fixed rates going? Okay, I see, this is just my view only. Don't act on it. Let's have a chat before you make these decisions. It was very, it was a very strong statement by all the banks that this P&I owner-occupied fixed rate was a benefit given to borrowers just for COVID-19. So I don't think that 2-year P&I owner-occupied fixed rate is going to be around forever. I do see that rate going back up, just because the bank's cost of funds are rising, and if their cost of funds aren't rising, their operational costs are definitely rising, and bad debts are definitely rising. So I don't see that rate around forever. But I don't know how long these promotional rates will be around. So I do eventually see them going up, but I'm not sure of the timing. Okay, that's it for questions. And okay, Angela Wong. So I just answered that question, Angela. I think they are likely to go up, but who knows when. The RBA has said that rates will be at 0.25 for a long time. And what I mean by long, they're actually setting that expectation for up to a 3-year period. So that's the sort of duration of the rate environment that we're seeing. All right, guys. We still got time for some questions. What's the time, Fiona?
5 to 2.
5 to 2. Okay. So we've still got time for a few more questions. I'll wait a minute. I'll wait a couple of minutes to see if any come through. If not, just want to say thank you, everyone, for tuning in today and for listening. Hope you got a lot out of it, and hope you found the information useful. And yeah, we'll be sharing more news like this. So thanks for joining, and stay tuned for more webinars from SF Capital, from myself and the team in the future. So I'll just stay on for a couple of minutes and answer any questions, but I just want to say thank you to everyone for joining us today and their time. So, okay, thanks, Angela. Okay, question from Dennis. Are you seeing borrowing capacity come down? Will this squeeze house prices? yeah, we're actually seeing borrowing capacity come down because lenders are changing their criteria. So for example, shading of rental income at 20% was very common. Now it's 30% for a lot of lenders. And then for salaried professionals who earn bonus income, like I said, that's being discounted more. So that's policy sort of driving down borrowing capacity. Like I said as well, LVRs are dropped. So there might be a hard cap on the LVR, even if there might be a hard cap on the LVR, even if you can achieve a higher borrowing amount. Thanks, Carly. Thanks for tuning in. Thanks, Dennis. All right, guys. We'll draw it into a close, and that's a wrap. Thanks, Linda, for tuning in as well. Okay, and that's a wrap.